Hey folks, this is Colin Richards, president and founder of Lord & Richards, and I am excited to be with you today to talk to you about one of the major concerns I think many of us have as we build a long-term financial future, right? Because we're looking ahead to the retirement that we want to enjoy. We're in the middle of it and we're hoping it doesn't get messed up. Right? And so we want to build a plan, a comprehensive plan that looks out into the future and addresses the challenges as well as the opportunities. At Lord & Richards, we call that a financial independence roadmap. And I'd love to conduct one of those with you. So what are the key elements of that? Well, we want to, of course, deal with our estate plan and our income plan, our healthcare issues, our tax issues. But one of the big ones has to do with investment growth and risk. And it's really challenging to try to predict what the markets are going to do in the future, right? After you've been through a pretty nasty market, those wounds are smarting, and you're wondering, what could I have done differently? Well, the neat thing is I'm going to be talking to you today about strategies that you can use to recover some growth over the next 10 years, okay? We're looking long-term. And I'm going to dive, first of all, into a recent report by Vanguard. Vanguard makes a point every year of projecting what they think investment returns are going to look like over the next 10 years. And they bring all the geopolitical risks, inflation, economic risks. And of course, they're just analyzing and predicting, right? Analyzing and predicting. They're not God. They don't know the future. But it is interesting, as I study the literature, that they've done a pretty good job. Of keeping their prediction, which is a range, right in the general area of where the market is headed. So these are not going to be predictions that are off base. So I appreciate that. I was talking to somebody recently and they just felt like, well, the best thing for everybody is just throw all your money in stocks and leave it there and take the hits. Well, that may not always be the best. And then the question is, which sector should you be investing in? How many of us have 10-year periods that we can give away and not get it right? A lot of times, Wall Street analysts wildly underpredict declines in the market. The largest ever prediction from a Wall Street firm, a respected Wall Street firm, was a negative 7.7. We tripled that last year, right? They never. It's always rosy, right? Signals are always buy or hold, never sell. But the reality is, let's take growth stocks here in the U.S. The S&P 500 has been negative 26 of the last 97 years that it's been tracked. So let's talk a little bit about what we see going forward, what we see in the future. And this is one firm's prediction, but let's start with U.S. stocks. The long-term average for the S&P, for example, the growth stocks here in our country are 9.3%. For the next 10 years, Vanguard is predicting a range of 3.1 to 5.1%. Yes, that is true. That's from one of the world's largest money managers that makes their money off of getting you to invest and hold stocks, stock indices, and so forth. Value stocks, much better at 4.7 to 6.7. And small cap, those are the aggressive firms that we usually expect a bigger opportunity, 5 to 7%. So quite a range, but none of them near that long-term average that people think that they can get of approaching 10%. And why is that important? Well, very often we are given unrealistic expectations of what the markets are going to return. And I'm not saying this to depress you. Forewarned is forearmed, because there are categories that have real opportunity. For example, international stocks. Vanguard thinks there's great opportunity there, a range of 7.4 to 9.4%, outperforming U.S. stocks by 40%. And remember, Vanguard has gotten these ranges pretty accurately in the past. Emerging markets, 7 to 9. So global actually better than just focusing in on those hot new markets. Bonds, fascinating, greater than U.S. growth stocks, 4.1 to 5.1%. Greater than U.S. growth stocks. U.S. high-yield bonds, 6.6 to 7.6. Some real opportunity there. And again, emerging market bonds, 6.4 to 7.4. So some great opportunities. But you say, Colin, how do I know where to pick from? I've got all of these, 16 different classes of stocks and bonds. How do I know where to go? Well, the reality is it's very difficult to pick the needle out of the haystack. So we're going to talk to you in our next segment about how to get invested in the haystack and really benefit from a globally diversified portfolio. So there are ways that you and I can do this, but here's the story behind this. Unfortunately, with Wall Street's constant buy signal, with its constant buy and hold strategy during down markets, a lot of times it can leave retirees a victim of what we call market timing or the sequence of returns. You see, it is unfortunate if you retire and then the market drops, or if the market drops at a key time when you're withdrawing, because it compounds your withdrawals. It compounds the negative impact of withdrawals. Additionally, the order in which you get returns can drastically change the outcome over your lifetime when you're withdrawing money from that portfolio. Drastically change when you would run out of money before you run out of life. So just throwing our money in there, hoping that it goes well, is not a strategy. What we need to do is we need to test, and retest what we're doing and see if our portfolio holds up. We call that process a financial independence review. And it begins by simply gathering together, having a wonderful conversation about your goals, your dreams, your values. And for married couples, we always meet together. It's really important because both of you have opinions about goals, dreams, and values, whether one of you handles the checkbook and the investments or not. But then in addition, we're going to gather your budget and your statements, and we're going to do some long-term forward projecting. 1,000 different markets. Project, test. And we're going to see how often those forward projections work out in your favor. Meaning, number one, you never run out of money before you run out of life, and you have an adequate supply of money throughout that lifetime. We don't ever want you to be bankrupted. And we're going to include other negative experiences, like what if one of you passes away early, or what if one of you becomes chronically ill. That's a financial independence review. And folks, you need this. You need this. It costs nothing to get this review, but yet it's a powerful, powerful tool that will help you make great decisions about where to invest going forward. And my team and I are helping people just like you every single day to get retired and stay retired. You know, somebody wisely said, you can't get a second opinion from the person who gave you the first. Isn't that true? Whether it's medical or whether it's financial. We get second opinions all the time about the critical decisions we're about to make that affect our health. I think it's time we get a second opinion about our wealth. I would love to talk to you. It just starts with a phone call.